Hi, everyone. Welcome and thank you for joining us. So this session is going to be just a little different from a traditional webinar. We're going to host it as kind of like a fireside chat to go along with our slides, and we want it to feel like a real conversation, the kind of conversations that we have every day with our clients. So this webinar is designed for accountants who aren't accountants. So business owners, office managers, project managers, and others who touch accounting but don't have formal training. So our goal today is to walk through what month and year end really look like in a construction environment, why it can feel overwhelming, and where things tend to go wrong.
If you guys have any questions during it, feel free to put them in chat, and Stacy will manage how we answer those. So like she said, we want it to feel super comfortable, so feel free to pop in whenever you like.
Yes. And introduction to our speakers. We have Suzanne Bach, who is a partner in our construction and tax practice. She also leads both of those. Very busy lady. She's brings deep experience in construction accounting, compliance, and advisory services. She helps contractors navigate complex financial, tax, and growth challenges and works closely with construction business owners on job profitability, risk management, and long-term planning. She's a frequent speaker on construction and tax topics, and she's super excited to be here with you today. We also have Jen Hogan, who's a director in our fractional CFO services. She works hands-on with construction companies to manage month-end close, job costing, WIP reporting, and financial decision-making. Jen brings the perspective of a seasoned CFO, helping owners and leadership teams turn financial data into clear, actionable insight that supports growth, profitability, and risk management. She also did a little stint in our audit department as well. So she knows exactly what those pesky auditors are looking for at year-end close. I say pesky, that's me. So we're going to kick things right off and start with talking about who is going to benefit from this. So we already discussed the accountants who aren't formally trained, anybody handling that kind of topic at the thing. So, all right. So why the close matters. Jen, could you maybe tell us a little bit about why construction close could be seen as a little bit more difficult than normal closes in other industries?
Yeah, definitely. There's added complexity, in the construction industry with the percentage of completion method of accounting and job costing and overhead allocation. And it's very heavily driven by estimates, which are very judgmental. And, you need really good financial information to inform those estimates and judgments that you're making. So, the job schedule as a whole really just adds that additional layer of complexity, to the closing process. And it really takes someone who knows the industry and, the accounting behind the industry to, understand that and do it effectively.
Yeah. I think also just to add to that, there's collaboration necessary between different departments. So the field needs to be talking to the accountants, and the project managers and the people in the field need to be communicating back to the accounting department like, hey, this job is 10%, John, or no, we had change orders. I need to get you copies of those change orders. Maybe the job is really only 5% done. And we really just set up. That's all as far as we got. So the collaboration between the teams is really important in construction that may not be present in some of other industries.
Yeah, and I would add to that just the cash flow element, the nature of the construction work and having to front load a lot of costs and get paid on the back end. That adds an additional layer of complexity that has to be managed, making sure that your cash flow is strong, and sometimes introduce the need for financing and other things that add more complexity to it.
Definitely. So when we get a new construction client, what's usually going on behind the scenes for their month-end close? Is it typically super organized and process ready, or is it a little bit more like the Wild West?
Yeah, well, certainly from my perspective, serving as a fractional CFO, we usually, partner with companies who do need some additional guidance and support. A lot of times, they're in a growth phase, and so they have some new, bonding requirements or financing requirements, or just, higher volume, and they're growing, and so a lot of times maybe they started out, the owner was handling some of the financial or accounting, tasks. Maybe they have a bookkeeper who is, maybe a family member, or, maybe someone that they knew that isn't necessarily, a CPA or doesn't have an accounting background, and they're a lot of times wearing multiple hats, not just doing the accounting work.
HR, office manager,
Yes.
emotional support.
Yeah. So a lot of times, when people onboard with us, typically they've gotten a little bit behind, sometimes a lot of bit behind in their accounting, and there's a little cleanup that needs to happen. There's usually a lot of questions around, what should I be doing? I'm doing X, Y, and Z, and I don't know if that's what I should be doing. And maybe if I should be doing anything else, what does the process look like, which, kind of lended itself to this webinar.
Yeah, there's definitely, contractors specifically are out doing their business, right? They're out making money, they're out doing jobs, and that's definitely their main focus, which is great. You want to have a profitable business. Accounting sometimes gets the back burner, maybe it gets overlooked. It's an expense they don't want to have or incur. It's, viewed as like, it's not revenue generating, but it not having accounting correct, and not having good statements, and not having, these things buttoned up can cause a lot of loss of revenue. But, it is definitely not like a revenue driver. And so sometimes it gets overlooked as not that important until it becomes important, right? I think you guys have probably all heard the saying from Mike Tyson, what is it? Something until you get punched in the face. Everything's great. I think everything's great until you get punched in the face. And so it's the minute your bonding company says, hey, you want this additional capacity, we need reviewed financials, or your banker says, hey, I can't increase your line of credit until you get reviewed financials, or you're closing on, again, a piece of equipment or something large, and you need, your tax returns and your financials up to date, and you don't have those things ready. And so it becomes very critical very, very quickly. And so a lot of our new clients are, oh my God, I've got to have this thing yesterday because I need it now. And so, like Jen said, sometimes we have a lot of clients that come to us in great shape, and then others, it's a bit of an emergency, and we've got to move pretty quickly to mobilize.
Mm-hmm.
No, totally. And, one thing we hear a lot is we're not accountants, like how perfect does it really need to be? So let's talk about that, right? So what is the cost of a bad close? What are the real world consequences when month and year end closes are not performed well?
Yeah, you want me to jump in, Suzanne?
Yeah, sure. Why don't you start and then I'll pitch in.
Sorry, I meant to say a name there.
That's okay. No, I mean, we've touched on some of it already, but garbage in, garbage out, right? If you don't have good books, if you're not closing, you don't have accurate information, the reports are not going to be useful to you for decision making. You're probably not going to have, you may not have a clear picture of the profitability of your jobs, or maybe you don't realize how significant your G&A expense has gotten. You can, miss billings, or, just
Speaking of
paying
billing,
late,
Yeah,
there's all kinds of, things that can go wrong when you aren't keeping up with it. And even if you are getting it correct, if it's significantly delayed, then that's not as useful to you either. People who maybe wait until the end of the year to finally get everything cleaned up, even if they've posted it all right and recorded everything perfectly, it's not really useful for decision making at that point.
Yeah, late. Speaking of the billings and things like that, a lot of clients that come to us new are recording billings as the cash comes in. So they don't even have an AR. They don't know who owes them money. They don't know when someone hasn't paid them. And so we've had contractors that have come to us that were like, oh, it's all in my head. Really? It's all in your head? Like, that's a lot to be in your head, right? I would prefer you focus on, something else instead of trying to remember who owes you money. That's the accountant's job. We can help there. And same thing with invoices is they don't put the invoice in the system until they actually pay the cash. And so that can, really mess with you if you don't, all of a sudden you get an invoice and you're like, I didn't even know I owed these people money. Well, you need to record it before you go ahead and pay it, so now that you have this surprise expense that maybe you didn't budget for, you didn't job cost for, you didn't estimate for, and that can, cause issues. And so just to add on what you've said, Jen, just overall though, having inaccurate or not timely financial reports can really cost your business a lot of money. So just staying up on this stuff, having, current relevant financials you can make decisions off of it's more important than some people think.
Suzanne, have you ever seen anybody lose bid or funding because they couldn't get their financials wrapped up in time?
So fortunately, yes, of course we have seen it. Fortunately, most of the time, we're able to jump in really quick. We can call the bonding company. We can say, look, they have, engaged us and we are on it. And could we just buy a little bit more time? Sometimes we don't have that flexibility. So we have seen that happen. Either a lost, again, line of credit increase or delayed or a lost job because they, did not have the statements in time because we just couldn't, get it done in time. But, we do sometimes have some flexibility if, we can get in front of the bonding company because we're pretty, in the market and in the business. And so we can say like, hey, we're on top of it, give us 2-3 weeks and, we'll have you like a draft or something that you can work off of. And so we're sometimes able to buy some time, but it is absolutely critical that, again, you keep up with it so you don't lose out on something.
Yeah, we've had a lot of those conversations on the audit side, and it's definitely the difference of having a construction specific CPA who does know this lingo and who does know the players, right, that they can reach out and say that. So I think that's great. And something else I kind of want the audience to hear from this discussion so far is that, right, closing your books is not just about compliance. Typically, no one's coming behind you saying, did you check these boxes, right? But it more impacts cash flow and bonding and decision making than anything. And as we talked about before, construction is completely different, right? And so it definitely brings some different aspects to it. So now we'll get into the fun part of the pre-close preparation, right? So Suzanne, from a risk standpoint, what do unreconciled accounts signal to lenders or bonding companies?
Usually that no one is paying attention. And so we have several indicators of that, and lenders and sureties know what they are. They're looking at the statement. Sometimes there'll be assets that are a negative number, and that's usually indicates like, hey, nobody really reconciled this account. They can see it within 2 minutes of glancing at the statement. They can say, okay, hey, this is in the wrong place, or this hasn't been reconciled, or you sometimes have to submit a copy of your cash statement from the bank and your balance sheet, and there's no reconciliation. And so the bank or bonding company is like, hey, I thought you had $100 in cash and the statement says you're negative 4,000 or whatever. Those are, cause alarm in the reader of those financial statements, because they're now going, okay, what else it hasn't been paid attention to? What else is wrong? If they even see one thing that's wrong, doubt has arisen in their head, and now they're like, what else?
Yeah.
I did want to touch real quickly, Stacy, on the previous slide, and just kind of going back to something that Suzanne mentioned earlier about, one of the differences in construction is that you're, relying on a lot of different people. You're working with the field agents, the accountants, are needing information from a lot of different people. So this, slide is just talking about pre-close preparation. I think it's important, to set yourself up for success. So even before, the month ends, don't wait till the first to start going through your monthly closeout checklist. Prior to the first, you want to be going ahead and reaching out to vendors, asking for invoices that you're expecting that you haven't gotten yet, reaching out to your project managers saying, hey, I'm going to be needing updated estimates from you, or have you submitted all your change orders or your contract amounts up to date? All the information that you need to gather from other people, you want to start gathering that before the end of the month, so that once you're ready to roll, you've got everything you need.
Right. Because if you haven't started all this stuff, then the reconciliations get a little harder. You're starting to reconcile things that still have
takes a
open.
lot longer to reconcile the January bank statement in August than it does to reconcile the August bank statement in September.
Yes. And Jen, those are such good points about getting prepared, to start doing this. Don't wait until the first, you can start knocking those things, like, especially if you're in QuickBooks, it's pretty easy to send those things where they need to go.
And we totally get that it may not be a priority because you've got a road to pave out here, but make it someone's priority, whether it's us or, someone internally or another firm, but make sure it's a priority for someone.
Yes. And so, are there any accounts that you guys see that tend to have more problems in them than not? So we think of bank reconciliations. A lot of people usually have those under lock, but do you typically see people reconciling their lines of credit and their equipment loans and stuff like that, intercompany balances?
Those would be the most commonly missed ones. Go ahead.
This sounds like a leading question, Stacey. Yes, a lot of times the equipment loans, the lines of credit, sometimes we see, issues with how payments are recorded, whether they're breaking out the principal, the interest, and things like that, or misclassifying things, suspense accounts. So a lot of times you can get your bank rec done if you throw unknown charges into an account, a clearing account, and ask my, accountant account. And that's fine to do, to get your books closed, but you don't want to let those things build up over time. You want to make sure that those are, getting zeroed out, because otherwise you think you've got everything recorded, your bank is reconciled and all of that, but what might belong on the P&L as a cost, or maybe needs to be an AR as a receivable, or whatever it is, might be sitting in that suspense account on your balance sheet and not, showing up where it needs to be.
Credit cards too are some that are often maybe a little bit behind. Like you said, Stacy, a lot of people figure, oh, if I just get my bank account reconciled, everything's good. I've done my accounting for the month. But like you said, there's credit cards, there's debt. We see that so much where there's balances in loans sitting on the balance sheet that have been paid off, sometimes for over a year. And they, have been making the payment against an expense account instead of to the balance sheet. And so I think you brought up lines of credit as well, where the line of credit on the statement doesn't tie at all to the actual line of credit. And that's something the bank will pick out because they'll like, that line of credit balance doesn't match the one that we have. And that raises a question again to, say like, hey, how are you doing your accounting?
Right. No, totally. That's such a great, and it sounds like there's some risk in leaving unreconciled month to month, as you were saying. Like you have loans on there, right, that you shouldn't be on there, and now they're getting counted against you. So you probably are more bondable, or have a better lending capacity than you truly are showing, but you wouldn't know because the lines of credit is higher than it should be.
Right. And, something that gets overlooked quite often are covenants in loans. And so there are sometimes some ratios that you have to meet in order to stay in compliance with your lender. And those are very often overlooked when someone is closing a loan. They're hidden in there, and maybe the banker brings them up, but you didn't quite, you're just so excited to get this new piece of equipment that you don't spend a lot of attention on it. And then month number one comes and the bank says, let me see your financials. And you send them in what you think are good financials, and they respond back with, hey, you failed the tangible, asset coverage, the debt service coverage ratio. And you're thinking, oh my God, I didn't even know I had a debt service coverage ratio. I don't even know what that is. And so that's something, during the month-end process, it's really important is to pay attention, to make sure that you are hitting those loan covenants. If you have any leases, sometimes have some requirements as well.
Such a great point. And we do include that in the slide deck. And just a heads up for everyone, we probably won't touch on everything in the slide deck, but I wanted to give you more information because we'll be sending it out. So if you see me skipping, we're not missing anything big, but you will get all of these. And I did include we did include a bank statement to the general ledger kind of reconciliation just to see, if something's out of whack, how you find it. In case you have any questions. All right, so moving on to one of my favorites is payroll and labor. So Jen, payroll always seems like it's a pain point, right? What are some of the most common payroll issues that you see?
Sure. I think, people handle payroll in, different ways, sometimes internally, sometimes you have it outsourced, or, it may be in a different system. So you may or may not need to reconcile your payroll system to your accounting system. But, for contractors specifically, job costing is a big piece of it, making sure that the payroll costs are allocated appropriately or assigned appropriately to the correct, general ledger accounts, assigned to the correct jobs or to G&A expense. Other things that we, see that, can add up and cause issues with reconciling later is, the payroll liabilities accounts, withholdings and taxes and things like that. Sometimes that's a little bit of a mystery if you're not, a CPA or, a payroll expert, if you don't have training in that payroll side. When those get out of whack, that can cause a little bit of a challenge to figure out what's going on there. So, those are some of the complexities that I would see. And, specifically, reconciling between like a job schedule, what costs are you seeing on your job schedule for labor versus, what are you seeing in the general ledger in your COGS accounts for labor versus what's in your, payroll system. So you want to make sure those are all aligned, so you're not missing any costs anywhere, having any hidden surprises there. Before I stop talking, I also wanted to just mention, we're going over a lot today, and it might be helpful. We do have a kind of a monthly checklist template that we pulled together, that if y'all are interested in following along with some of this or taking notes, we can share that. I don't know, Stacy, is that something you could, or Nancy could drop in the chat? We'll definitely email it out. But that was something I thought might be helpful if people wanted to follow along, if we were able to share that.
Yeah, and then on payroll, it's again kind of an often overlooked area is many of our construction clients allocate their indirect costs or their overhead allocation by labor cost. So if you are not allocating your labor correctly to the jobs, that can cause a huge problem when you go to allocate your indirect or your overhead costs, because they will be allocated wrong because your labor was wrong. So that's something, to pay attention to Jen's point, making sure they go to the correct job and the correct classification. One time we had a client recently, it was a new client that a lot of their indirect people were going to cost of sales, so going to direct labor. So when we went to reconcile the job schedule to the P&L, to the, you know, cost of goods account, it was way off. And so we started to dive into like, okay, why is this the case? And it ended up that there was a bunch of people that were hitting their direct labor that should have been in overhead. And so that again, that causes a big problem. Whereas maybe in another industry, it wouldn't be as relevant because you're not tying your cogs to a job schedule and things like that. And so it becomes very relevant for contractors to make sure that's recorded correctly.
Yeah, I was just about to ask you if, sorry, Jen, go ahead.
Go ahead, Stace.
I was just about to ask you, you know, like how badly could miscoded labor actually affect job profitability? You know,
that's what I was about to jump on.
Go ahead, Jen.
Your mention of overhead allocation, because, you know, that really does amplify the issue. You know, if you code labor to the wrong job, you know, you obviously overstate one job, you understate another job. And then when you allocate your overhead, if it's based on labor or if it's based on cost, or even if it's based on revenue, whatever it's based on, if that initial job profitability number is skewed, when you allocate your overhead, you know, that's going to amplify that problem. So, you know, your jobs that may look more profitable than they are because they're missing some labor. And then on the flip side, you may have a job that you think was going well and looks like a loss. And you're like, what's going on here? You know, has some added labor in there that you know, shouldn't be there.
Yeah, no, those are all such great points. I definitely see a lot of that on the audit side where we get in and start digging around like Suzanne said. So definitely something to keep an eye on, and making sure that, you know, reconciling payroll and having great controls around it as well. All right, so I did include a cute little reconciliation picture so that when you're going through and you're like, what do I need to reconcile my payroll? We wanted to make sure you had a picture of all of the things you need. So
hopefully they're electronic, or we're going to have a whole different webinar for you.
If you have paper that you're printing out, please come see us.
Yes, please call us.
All right, so moving on to accounts payable. This, you know, is kind of where companies tend to usually underestimate, right, is ARAP. So how often are you guys seeing issues in accounts payable, and what typically are the most prevalent ones?
One thing that I see quite often is misapplied payments, you know, so payments that don't get applied to the correct invoice. And so it looks like an invoice is still outstanding, you still owe money, you know, to a certain vendor that you've already paid, or maybe it just gets really messy because you see ins and outs, and makes it very hard for you to follow, you know, what is, you know, you have your accounts payable list and it's all muddied up with these ins and outs, or maybe you run a different report like open invoices and it's showing stuff that's been paid because the payment didn't get applied to the invoice. So those are some of the things that just get a little bit messy in there. You know, but another, you know, I guess reason that I think it's important to keep up with it and review it and make sure it's accurate is you certainly don't want to be, you know, paying your vendors late. You know, that can impact your credibility. You can incur late fees, things like that, just unnecessary expense and headaches. You know, it's not efficient. So just important to keep an eye on it and make sure that you know what you're doing. If you have a good, clean payable report and good financials, you know, you can benchmark with the industry to see, you know, are my payment terms in line with the industry? You know, this is how long I'm paying, you know, taking to pay my invoices. Does that, you know, match up, or should I be negotiating more favorable terms? Things like that.
Mm-hmm. That's a great point from a cash flow perspective. We advise on that often is, hey, what are your receivable terms? And if they're sometimes 90 days, it depends on your customer. Have you also tried to negotiate the cost to be commensurate with that payment, when you're going to get paid? And that's not always possible, right? We have a lot of, clients that say there's just no way I can pay people that late, but it's a negotiation, piece. You don't know till you ask. And so we often recommend you try to go negotiate different terms, depending on the situation. Also I brought it up earlier, but just to remind everybody, when there are costs that maybe you don't have recorded because you haven't gotten the bill yet. I hear that all the time. Well, I didn't get the bill yet, but it's there, it's coming. So not many clients accrue. It's called accrue in our world, which means book the expense even though you don't have the bill yet. If it's going to come and it's $100,000, then you should probably book it as $100,000, when that it's due, even if you didn't get the bill yet, because that's going to make all of your financial statements look like you're making $100,000 more than you actually are. It's going to make that job look funny. It's going to make your overall statements look funny. So thinking about, and that's, the really important part about the close process is that's on the checklist. Like, hey, are there any bills that you should have that you haven't recorded? That's just something really common that we see that people don't think about. And of course, at year end, it matters a lot because if you are a cash basis taxpayer or a percentage of completion basis taxpayer, whether those invoices are accrued or paid, it matters. And so again, at year end, it's really important to make sure that you have all of that captured.
Those are such great points, especially during year end. And especially if the job is also closing. If you think the job is closed, then you close it out and there's something that you haven't accrued. What would you say are the biggest red flags in AP?
Having old outstanding AP, high balances in the 91 and over, or sometimes even in the 60 and over category. That would be a big one.
Yeah.
Negative balances, again, like that. So what'd you say, Stacey?
Negative AP.
Yeah.
Yeah, negative AP. And that happens a lot when like credit memos come. And so again, sometimes it's timing. Like the client will tell me, oh, I got a credit memo. Okay, well, where's the bill that the credit memo offsets? Because sometimes the credit memo makes it, but the bill didn't make it. And now they have this huge negative, or the timing of it where, the invoice comes in December, but the credit memo doesn't come until January. And that, again, those timing issues can be really important at year end. So you want to make sure you're on top of just knowing and paying attention to those things.
Yeah, absolutely. And just as a little visual for you here, we've got a little AP aging summary and a little trial balance. So you can see that total of 6,885 ties to the accounts payable line on the trial balance. So there's a definite red flag to look for. If those two are different numbers, that usually requires a little bit more digging. So now we're going to move to AP's counterpart, accounts receivable. And so Jen, what's the risk of delaying bills? So even if the job isn't going well, you may think that there's some change orders coming. What would be the risk of not sending out that bill? Let's say like we're close to year end.
Yeah, well, I mean, you would, if you're not sending the bill and certainly if you're not recording it until you send it, then you're misstating, your financial position. You're leaving off a receivable, which is an asset. That's going to be really important for some of the ratios that the lenders are looking at, lenders or sureties are looking at. But probably more importantly is your cash flow. If you're not billing, then you're not getting paid. So that's going to be critical. If you're operating on like a line of credit and you're having to borrow, you're incurring interest that you wouldn't otherwise need to incur, if you were billing and caught up. And your billing, process is something that I think, the lenders and the sureties really look closely at. Are you billing timely? Are you following up on your collections? Are you over or under billed? Those are things that they're really paying attention to, and they can tell if it's not something that you're following up on and keeping an eye on. And the longer things get pushed out, the later that you bill for something, the increased likelihood there is for a collection issue to come up. So sometimes it's as simply, you can lose that revenue if you push it out too far. So those are some of the things I think of.
Yeah. Suzanne, at what point does AR become a warning sign and not just like a timing issue?
So yeah, I was going to mention after Jen just said all that the further it gets, the older it gets, the further it's discounted. And so if something is, 90 plus days, a lender or a surety may discount that. So instead of being a $100,000 asset, now it's a $70,000 asset because they've discounted it 30%. They said, hey, the likelihood of you collecting it is now 70%, not 100%. And so they'll discount it and not let you have that full amount. So again, back to just making sure every month you know how much people owe you, you know how old it is. You've got someone hopefully on top of that. Sometimes it's a project manager, sometimes it's someone in accounting, but calling on past due accounts. And Jen made a great point. If you're using your credit line to finance your operations and you're paying extra interest, now you're pretty much allowing your clients to have, free loans if you're not charging them interest. And so they're using you like a bank. And so it's really important to keep an eye on that. And it's definitely something that external people, again, banks and sureties look at quite a bit, is to make sure, is the AR good? Is it collectible? And, do they need to discount it? So when it becomes a problem is when it gets really old or it's not valid. So we, as part of an audit, if you have to have a full-blown audit, part of an audit is to send confirmation to the customer and say, hey, ABC company says that you owe them $100. And that customer has to say, yep, I agree, I owe them $100. We see all the time that they don't agree. They say they don't owe you $100. They only owe you $45. Oh, well, there was a credit memo, blah, 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 and then we're back and forth for, sometimes a couple weeks trying to figure out who's right. Is it the $100 or is it the $45? And so that's a problem, becomes a problem, because then it's delaying, again, your audited financials. It's now making the client and the customer kind of, antsy, like, why do you think I owe you more money than I owe you? So, having that reconciliation process every month, where you're staying on top of it and communicating with your clients, understanding if there are credit memos, talking to the field guys, because maybe they made a credit memo and you didn't know about it. And it didn't hit accounting, it had just hit the field, and the field guys all know about it, but the accounting department doesn't. So those can cause real problems.
I would just add to that too, one of the common issues that we see, with people who are maybe less familiar with, how the accounting softwares work, is like a duplicate revenue recording. So if you, record a bill, an invoice, that you're billing your client, it records, the revenue and the AR at that point. And then if you receive payment and you record that, payment again as revenue instead of applying it to the invoice to clear out that AR, then you inflate your revenue. So you're looking at your financials thinking like, oh, we're doing great, and but in the meantime, you're doubling up, on your revenue that you're booking. So that's another reason it's important to review the AR aging, not just tie it, make sure it agrees, but to look at it and say, wait a minute, there's something on here. I thought we got paid, for that. Why is that still showing on our AR report? That could be an indicator that, you accidentally, duplicated that revenue.
Yeah. And that's, really important about closing, is that you will find these things and they will be caught current, not 6 months down the road. They'll be caught current, because every month you're going to be looking at it and you're going to know, like, oh, I think they paid us, or oh, wow, they haven't paid us. And you'll have, very current opportunity then to give them a call, instead of 6 months down the road. Now you've got probably a little bit of a disagreement on your hands.
Sure. Yeah. And collection issues are much easier to resolve when, you catch them early. It can be a simple, oh, we missed the invoice. Okay. And all it took was you saying, oh, I'm surprised they haven't paid. They usually pay on time. Let me hit them up, send them a copy of the invoice, easy peasy. But when it gets later and later and later, that's when it becomes, a little hairier to try to resolve those.
Yeah.
Love that. All right. So the fun part, the reason why we're all here is because we love work in progress schedules. So Suzanne, why does job costing and the work in progress schedule feel like the hardest part of the close for the construction company?
So we have a lot of clients that have a very, very accurate WIP, meaning they know exactly what's going on in the field. And they have, here's all my open jobs, here's how much I spent on them, here's how far along they are, percentage of completion, percentage of billing, et cetera, et cetera. And then we take it and then we go to match it to the balance sheet and the P&L, and it does not tie. Sometimes it's just a little bit off and sometimes it's way off. And so we're like, okay, well, you told us that job, A, B, and C, all the job costs of those 3 jobs totals $1 million. So then we go to your P&L and we see that your cost of sales was $8 million. So where is the other 7? Where did it go? It should tie. And so if you have a WIP schedule that's got costs, you need to be tying those costs every single month to your P&L to say, okay, cost of goods sold on my P&L was 100 grand. And then I need to go add up all the costs of my jobs and see if they also equal 100 grand, because they should. It's very likely that they don't, if you don't have a closing process. If you don't do this on a monthly basis, it's likely that those 2 numbers won't match, and you'll need to spend some time reconciling them. And that can be very, very time consuming if, it's been many, many months. And so now you're like, oh my God, I need reviewed statements. And so we, get the data from you and we start to tie things out and we're pretty far off. We now have to go through a whole year to say, okay, what are the actual job costs, and allocate them by job, make sure they tie to your P&L, to your cost of goods sold account. It can be a very time consuming process. We have a couple clients who are new to us, new to Saltmarsh, that are in the middle of that project right now. And they will tell you that it is very frustrating to go back 12 months and try to figure out where the costs go. So if we're promoting anything today, it's promoting monthly, review of these types of things so they don't get too far out of control. And then it just takes so much more time to go back and fix it. So the job schedule not only ties into your P&L, it also ties into your balance sheet. And so there's something called over under billings. And so that is whether you are overbilled or underbilled, those get recorded, based on your percentages of the job. So if you're X% complete, there is an entry that's recorded to book your over or under billings based on your percentage of completion. So the estimates of the job are super important, back to those, field accounting collaboration meetings. Accounting may say, oh, the job is, 10% complete. But then I call the project manager and he's like, it's almost done. In fact, I only have a punch list left. And you're like, oh, okay. So there's something disconnected here. There's a problem. And so having those monthly check-ins with the field and the accounting team can, resolve all of those types of issues. And so it not only affects your P&L, but it also affects your balance sheet. And that affects your assets and your liabilities. And so if those are not accurate or don't represent the actual true, what's happening, again, it can make your financial statements look very bad or potentially very good, but not, factual. And so either situation isn't good. And so another indicator, like if a surety is looking at your statements and you don't have over under billings, if there are no over under billings, they automatically know you're not making that monthly entry and you're not recording the over under billings. So they're already going to be like, yeah, there's something wrong with these statements because there are no over under billings. So not tying out the job schedule to the financial statements can be very detrimental in multiple ways.
Yeah, you mentioned 2 things that I wanted to touch on, Suzanne. When you have an issue, something's not matching up and, you wait till the end of the year, sometimes those are very simple, easy fixes. Like there's a button you need to click in the payroll system to make sure that, this defaults to this certain way, or that, it asks you what job it goes to or whatever it might be. And if you catch those early on and fix it, then okay, it stops the bleed, right? All the other ones are going to be done correctly. But if you wait until the end of the year, it's like your whole payroll has to be fixed. You have all these employees that were, set up wrong, and you have to go back and fix. So it's another reason we just say, looking at it monthly, sometimes it's a really easy fix. When you can identify what's going on, and, so don't wait, to look at it. The other thing I wanted to touch on was, change orders, getting those in to the system. That's something that we can see sometimes. People may, get their costs up to date because they're seeing the actual costs come in. And so they're like, okay, well, I'm paying these bills. But on the contract side, if you haven't entered the change order, to increase your contract value, then that job, you're going to miss out on the revenue, because when you go to calculate, your percent complete, you're going to say, okay, well, my costs, I've completed X percent of the job, 90%, but your contract amount is wrong. So you're only going to recognize 90% of $100,000 instead of $500,000. So it's really important to make sure that those change orders get entered as well, and that you're updating your total projected cost or your estimated cost to complete. And not just the actual costs in there. So those are just really important pieces to keep an eye on.
I love that. And, we see a lot of clients that come to us and, they have an outsourced accountant that they use, but that outsourced accountant is not construction specific. Have you guys experienced where you guys look at financial statements and you automatically know that this other outsourced accountant is not a construction niched CPA?
So it's usually back to that, does the job schedule tie? So if you ask the client for, hey, can I see your internal financials and your job report? Within seconds, you can tell, okay, does this tie? And are there over under billings that exist? Because sometimes there aren't. And then one really quick question always is, hey, how do you allocate overhead? How is your overhead being allocated? And we get the response a lot of times like, oh, we don't have to allocate overhead. That's not required. It actually is under GAAP. So if you do have reviewed financials or audited financials, it is required. And it's required that it be consistent. So we spend a lot of time, coming up with a methodology and making sure it's done monthly. So that's maybe not visible necessarily when you glance at a financial statement, but within one question, you can, determine whether or not it's being allocated. Also, something that would indicate it by just looking at the numbers is if your G&A, so your expenses like repairs, depreciation, fuel, office supplies, insurance, things like that. If that number is very, very high on the P&L and your cost of sales is showing maybe a bit of a high margin. So if you've got margins, say in the 40%, but your industry is really more like 20%, the other 20% is probably sitting in your general and administrative expenses because they haven't been allocated to cost of goods sold. So that will pop out pretty quickly to those that are trained to look at it, because they're going to say that margin is a little bit high for that type of industry and that location. And so then that may indicate that if your G&A, percentage is a bit also high, meaning G&A is a high percentage of your total revenue, then it indicates that maybe overhead allocation was not made. So those would be kind of the top couple things that I look at quickly.
Yeah. Oh gosh, sorry. I scrolled on the wrong thing. No, that's all really super, super great information. I think people think CPAs are all alike, and our contractors quickly realize once they come to us how specific and niche construction accounting is. So
Yeah, and it's definitely not all industries are created equal. And, it's part of the reason, like, the three of us are in it. We love the complexity of it. We love the nuances of it. To me, makes it so much more fun to work with contractors. So if you are working, with a CPA that's not construction, there are some things that you should have your eyes open to make sure that at least you're paying attention to on a monthly basis.
I agree. I would also throw out there, we've worked with clients before where their accountant, maybe they knew enough to be dangerous and they knew that they needed to allocate overhead, but they maybe didn't, use a basis that made a lot of sense, for the client. Like that can definitely distort the profitability of the jobs. It can distort the gain fade. Sorry. And if it's not tied, if it's not consistent with how you're estimating and bidding jobs, then that also makes it hard to, track budget versus actual and see how you're performing against your expectations. So, knowing the different ways that you can allocate the overhead, how to do that, and what makes sense is another important element.
Yes, absolutely. I've definitely seen methodologies of overhead allocation that just tank a job or, make a job look great. And then when we adjust it, I'm like, oh, that one wasn't so good. So I did leave this on here, this adjusting journal entries. We left this on here so that you guys can kind of see what your year-end adjusting journal entries will look like. We are getting close to time, so I'm going to kind of fast forward to the year-end close so that we can kind of touch on that. So year-end, right? Like, why is this so much different than a typical closing in August? Jen, what would make year end so much more difficult?
Yeah, there's a few things, that get added at the end of the year that, maybe it doesn't make sense to do them on a monthly, basis or quarterly basis, or just from a kind of cost benefit perspective, maybe just for efficiency purposes, something like, we'll use depreciation expense as an example. That's something that sometimes you can estimate at the beginning of the year and you can just record your depreciation expense as an estimate throughout the year. But then at the end of the year, you do need to true up, clean up that depreciation schedule, make sure it's got all your additions, on it, anything you added during the year that, any disposals, anything that you don't have anymore, that gets cleaned up, taken off, and you adjust your depreciation expense at the end of the year. So things like that, you're showing it on here, inventory counts, truing up your WIP, all of that. It's just, you take that extra step to make sure everything is nailed down and accurate for the things that you may not spend as much time on throughout the year.
Awesome. Suzanne, do you have anything to add on year end? I know that we love as
I was going to say, if you need a pictorial reference as to how the CPA or the surety or the banker likes to receive your financials, it is like this, wrapped in a bow. If you can imagine, you're building your beautiful present for your family member, and you want everything to be perfect, and all the tape is in the right spot, and the lines are lined up. I don't wrap like this, but I know Stacy does, so I'm doing this for her benefit.
I do make financial statements like this, though.
Financial statements 100%, but like wrapping, I'm like, here's a bag. But just imagine like the perfect gift, and it's been wrapped in a bow and it has been given to someone, and that is your picture reference for how your financials should go to an external party. You try to have everything wrapped up until then you send it to get a review or an audit or to the surety. You want to make sure you're sending them something that doesn't add a lot of questions or does not raise doubt in their mind. You want them to get them and say, yep, these are great, everything ties, everything looks good, I have very few questions. That is going to reduce everyone's stress all around. So maybe just the picture reference when you think about how should my accounting look like.
Yes, I love that. And then obviously we know that the financial statements affect tax and bonding and compliance. So that's mainly why our contractors are getting reviews and all the fun things. You don't have to do this alone, right? Like this is a lot. I'm sure everyone here is maybe scratching their heads a little bit. Oh my gosh, this is way more than I thought I could take.
I did not sign up for this.
Yeah, like
I thought I was just doing bank statements.
Yeah, I just married a contractor. Why am I here again? My aunt was my uncle's bookkeeper, so I definitely understand and I love it. But we're here for a reason, right? Outsourced CFOs and CPAs, we exist for a reason. So we're here to support you. If you guys have any questions, you can reach out to anyone on this call. We're more than happy. Now I'm going to go to my favorite slide. Questions? Does anybody have questions? Please feel free to throw them in the chat. I'll get started with one that I did receive before our webinar started was when do you know that DIY accounting just isn't working anymore? Like when should I call someone and say, hey, I need help?
Yeah, I mean, you should know it in your gut. Like if you feel like you are overwhelmed, you lack confidence, you're unsure, that's a good indicator. If you are multiple months behind on reconciliations, Suzanne, I'm having a coughing
I was going to say, I'll take it while you're choking.
Even the thought of unreconciled, it gets us.
Yeah, no, for sure. I mean, everybody sort of knows, to Jen's point, you have a gut like, hey, I'm a few months behind. If you have growth, that's one of my biggest things, is if the company is growing and you have goals and you're looking to, increase profitability, just anything outside of the normal, just basic month to month kind of thing, that needs someone else, right? You need someone else to get involved, to help you, give you advice, make sure you're cleaned up. You're going to need loans, you're going to need bonding, you're going to need good solid tax planning and strategy and long-term planning, things like that. So, but I totally agree with Jen. I mean, you kind of know, like I know when I have a DIY project at home, if it's above my, limit or not. Like if we're redoing plumbing, I'm not the girl, right? But if it's like a small little whatever, I can do it, right? But I kind of know. And then if you think, oh, I got this, and you dive in and you don't got it, then and then you call us. Hopefully it's not too late. We recommend doing it before that. Because that costs more money sometimes. Just like if I screw up my plumbing, it's not good. It's better if I just call a plumber. Stacy's very familiar with that recently as well. She's been doing some home projects. So we all know if you screw something up, it's way more expensive to fix it later. I saw a couple comments in chat. Yep. I know we
got a question in the chat. Have you had good experience with external bookkeeping firms for a construction firm with a volume of $10 million?
If you're using us, yes, we have great experiences. So shameless plug, but Stacey mentioned it earlier, we have had some people come to us that they come to us for tax or reviewed statements or something, and they have an external bookkeeper. Many times that external bookkeeper is very qualified to do a professional service firm or a florist or a medical, doctor. They are not always qualified to do construction. It is, again, a very specialized industry that has specialized knowledge. There are certifications that you get specifically for contractors. In our world, we have to take continuing education. There's entire industry, education requirements for people that work on contractors. So yes, we have had good experience with some, and we have also had not good experience with some. And 10 million is about the, it's kind of the marker of like, hey, are you a small business or are you getting, kind of into medium-sized business? You're starting to need things at $10 million. You're starting to need credit lines and bond capacity increases and things like that. And so that might be the tipping point of where, hey, maybe my bookkeeper that doesn't know construction too well has been able to get by, but at this point maybe we need to start paying attention to getting somebody with a little more industry knowledge. That's my 2 cents.
Love that. And then we've got one more, and then we'll let everyone go. What advice would you have for construction accountants determining what and how much overhead should be allocated to jobs?
This is an entirely different webinar. So that is like a whole webinar in and of itself. A quick answer is if you run through your P&L and you look at your expenses, what should be, again, this is kind of a gut, what should be truly a job cost versus a general and administrative. So insurance, would you have to have a huge liability policy if you did not have guys on roofs or out in traffic or, XYZ in someone's home? Probably not, right? Your insurance policy would be very cheap and very small. So is that a direct expense, or is that an overhead? It's an overhead expense. It needs to be applied to jobs because it's the job's fault that you have this insurance. Same thing with depreciation. You wouldn't have depreciation if you didn't have equipment. If you don't have equipment, you can't do jobs. So you've got to just kind of roll through your expenses and look at what is really kind of a job cost versus a general and administrative cost. That's the very quick and dirty answer. And that's a good way to start, though. Just roll through your G&A. Percentage wise, we see it across the board. So again, this is like a whole webinar, but we see it somewhere, let's call it 7 to 20% is a pretty big range. I understand that, but there's a lot of different types of construction companies out there. And so some may run 7 and some may run 30. So it just depends, but I want to say 15 is probably the average. 15% of, your total revenue is overhead.
Yeah, I would just add to that too, with your G&A expense, I've had the question come up before, should I be allocating all of my G&A expense to jobs, or only a portion? And if so, how much from that respect? And generally, you would not be allocating 100% of your G&A expense. There's usually some items in your G&A expenses that it doesn't make sense to allocate in your overhead allocation. And that would be the things that, you're going to pay them. They're going to exist. It's a part of having a company. And even if you had no jobs, then those costs would still be there. You would still have to pay those costs, usually a portion of the owner's, compensation. Maybe it's, it could be the building or corporate, licenses and things like that. Just the basics of owning a business that don't necessarily fluctuate based on the number of jobs that you have. So there's always going to be some costs that are not included in that overhead allocation.
If this very brief question or answer did not answer your question, please call any of us. We are happy to talk for the next 3 hours on overhead. All 3 of us love overhead. We love talking about overhead. We love allocating overhead. So when I say please feel free to drop us a DM in our LinkedIn or an email or however you'd like to get a hold of us, smoke signal, we would love to chat with you.
I promise we are also fun at parties. I promise.
Oh yes, we have great parties.
We love overhead and we're fun at parties.
Yes. So we just wanted to say a huge thank you. If there was one takeaway that we had today, it's that a strong close doesn't happen accidentally. It's built intentionally through processes and procedures and honestly just being intentional. So we're going to share the month and year and checklist. It's in the chat, but we'll also send it out in the next 24 hours. And if you're struggling with any part of this process, it's very normal in construction. We've seen it a lot. Call us. We would love to hear from you. So Suzanne and Jen work closely with construction companies on a day-to-day basis, and they love bringing clarity and discipline to this process. So thank you for joining us, and thank you, Suzanne and Jen. We had so much fun.
Thank you guys.
Love this.
For coming. Appreciate it.
Thank you.